morning, everybody, and a very, very warm welcome to you all, executive members and representatives from business organizations and the financial sector, Deputy Governor Dr. Sandra Sukram, and members of the Central Bank Board of Directors, members of the media, management and staff at the bank, regional central bank governors, and members of the public who have joined us via the live stream. Thank you for your interest in the business of the bank and, by extension, the country, and for taking the time to attend the launch of the 2017 Financial Stability Report. Allow me to acknowledge the members of the head table: Governor Dr. Alvin Hilaire, Acting Inspector of Financial Institutions Mr. Patrick Solomon, and Deputy Inspector Banks, Non-Banks and Payment Systems Oversight. Oh my gosh, Mrs. Michelle Francis Panto. They will make exciting presentations this morning, which we hope will provoke deep questions and generate productive conversations and actions. As is customary, you will have the opportunity to raise your questions following the presentations, and we will respond to the best of our ability. You would have received packages when you arrived with copies of the program, today's presentations, the Financial Stability Report, and visual summaries of the FSR, and the recently published Monetary Policy Report. All of these are already on the website, and if you are so minded, you can access them on your mobiles and other devices, even as we sit here. For those of you present, well, for those of you here, I mean not on the live stream, your packages also include Wi-Fi passwords to facilitate easy access to the internet. I could see how impressed you are with all of this, yeah? Before I invite Patrick to the podium, I would like to share with you how important it is to the bank to engage you, our stakeholders, in meaningful and impactful ways. We invested significant time in preparing our publications and our presentations, drawing on the talents of many of our staff: research, information services, external relations, FTIS, and FISD, and I would like to recognize them for the high quality of work that was produced, but moreover, for their dedication and commitment to service. You know yourselves. I would also like to thank the Support Services Department for your tremendous support in arranging for this morning's event. Thank you all. We are optimistic that you will appreciate our efforts at communicating heavy technical material in ways that make things easier to digest. For example, our visual summaries for each report were introduced for the first time so that at a quick glance, you can get a full picture of what is contained in the detailed publications. We would value your feedback to us following the launch and your review of the material. Effective communication is one of our goals, and our strategic plan 2016-17 to 2020-21 specifically refers to advancing central bank public education and communication. Enhancements to our website, publications, and interfaces with you are the tangible ways that we are seeking to progress this strategic objective. Once again, welcome to the presentation of the 2017 Financial Stability Report. It is my privilege and pleasure to invite Mr. Patrick Solomon, Acting Inspector of Financial Institutions, to the podium for his presentation, which will focus on a review of the financial sector performance. Warmly welcome to his debut Financial Stability Report presentation.
Thank you, Nicole. Good morning, ladies and gentlemen. All protocols observed. It is a pleasure to be part of the team delivering the 2017 Financial Stability Report. The presentation today will take the following format. First of all, we look at understanding what is financial stability, the financial sector performance review, 2017 vulnerabilities and risk assessment, and regulatory and supervisory issues associated with cryptocurrency. This aspect of the presentation will be done by the Deputy Inspector, Michelle Francis Panto. Understanding financial stability. This is important. Some people define financial stability from a negative point of view. What is instability? But our definition of financial stability speaks about resilience. And resilience is the ability to recover following a disruptive event. In this case, is adverse shocks so as to enable the continued smooth functioning of financial intermediation and the payment system. That is important. The annual financial stability report of the bank provides an overview of the developments in the financial sector and showcases the bank's efforts to strengthen macro financial system. Before we begin looking at the domestic situation, we thought it was important to look at the financial stability risks facing our international counterparts. And these are some of the issues raised in the various financial stability reports. If you look at the United States, they stress things like policy uncertainty. We understand why. Crypto assets, trade tensions. If we look at Canada, they speak to household debt, high house prices, United Kingdom, household debt, geopolitical tensions. Coming to Latin America and the Caribbean, you look at monetary policy normalization. De-risking is an issue that we often speak of, and capital outflows. So now that we understand the context of it in terms of the international scene, we will move to the domestic situation where we would look at the performance of our financial system. So the first thing that we look at is the domestic financial sector. We estimated this to be about $316 billion, and what is regulated by the central bank represents 80% of that. So we regulate the banks, the insurance companies, and the pension funds. We then move to what we consider to be the key soundness indicators. If we look at the financial system overall, we could say that the financial system is robust and resilient. And it is robust and resilient based on the key financial soundness indicators for the banking sector, the life sector, and the non-life sectors. We will deal with the banking sector. So the banking sector is robust and resilient, and based on the key financial soundness indicators, as you see on the monitors there, capital is adequate. So when we look at regulatory capital to risk-weighted assets, we recognize that Basel I speaks to about 8%. On the average, we look at 23.8% as at December 2016 and 23.4% as at December 2017. So we have high levels of capital, and you know the purpose of capital is to a buffer to absorb losses if they occur. Looking at the key financial soundness indicators, one of the for the banking sector, you'll realize that it is stable. If you look at December 2013 to December 2017, the ratios have not changed materially. So that is an advantage. Stability is an advantage. Another part of the banking sector is that the asset quality continues to be strong. And how do we measure the asset quality? We look at the non-performing loans to total loans. And for the last 3 years in this slide, you recognize that the non-performing loans to total loans is declining from 3.7% and is currently 3% of the total loan portfolio. We look then at liquidity. And when we look at liquidity, the liquidity is sound. Between December 31st, 2016, it declined like from 21.8% to 19.7%. But that is no cause for concern. When we look at the excess daily liquidity held in the central bank, at the end of 2016, this totaled $4 billion. Then we go to December 2017, this had declined to $3.1 billion. As at May this year, it was around 2.6, and it is going up again. It currently is now $3 billion. So the significance of this is that this is excess daily reserves held in the central bank. the banks do not get any money on this. So it means that the liquidity is robust or strong, and it can be used to grant credit. And the reason why you would have it here is the fact of lack of bankable propositions. Another leading indicator of the key soundness indicator is the return on equity in the banking sector. And the return on equity in the banking sector, as you see, it is increasing, is more or less stable between December 2016 and December 2017. And if you look at another leading indicator, is the return on assets in the banking sector is about 2.9%. So, and all indicators show that the financial system for the banks, they continue to be robust and resilient, and the figures are showing that. We now look at the life insurance sector. This sector continues to experience growth at about 9% to 25.6 billion as at December 2017. In terms of profitability, the investment yield has been relatively stable over the last 5 years, holding steady at around 4.7, as you can see from the trend on the screens. The profits has been healthy, although there has been some fluctuation caused by unrealized fair value fluctuations or changes in actuarial assumptions. Over the last 5 years, the profitability, that is the profit before tax, has been increasing for the life sector and stood at 715 million in 2017, an increase of 24 million increase from 2016. The return on equity fluctuated again, and it declined between 2016 and 17. It moved from 15.4% to 13.8%. We now look at the non-life sector. The total assets stood at around 6 billion, an increase of 6.8%. When we look at the main contributors to the asset, we recognize that motor premiums, 39%, and property life continued to dominate, and this is of the gross premium. So the main categories of income would be motor and property life. What is interesting is that the underwriting profit declined in 2017, actually to the lowest point in 5 years, on account of several reasons. The first reason is the contraction in premium business. We saw softening of rates and decrease in demand for insurance services, especially from the energy sector, and strong competition. This was further worsened by significant claims incurred from the severe hurricanes in September 2017. Remember Irma and Maria and the devastating impact it had. This increased the net loss ratio in this sector from 47.2% to 55.1% in 2017. So the net loss ratio is obviously the claims paid divided by the earned premium. So what we are seeing is the reason for the decline in this sector. What is good news is that the capital base didn't shrink, in the sense that the insurers were protected by adequate reinsurance. We look at the occupational pension plans, and as at the end of December, we looked at 186 registered plans, assets totaling $49 billion, a significant amount under management. The corporate trustees registered under the Financial Institutions Act manage approximately 82% of all the pension plans. The asset mix in the pension plans is the majority is TT equity, which is around 28%, and government securities, 30%. A point to note is that 44 of the 186 plans are sponsored by the government or government-related entities. And this accounts for about 60% of the total pension sector assets, about 29 billion, and 48% of the total membership, which is 46,000. Though there are no financial stability risk issues in this sector, there are a few challenges. One, the number of defined benefit plans in the system, and with the low interest rate environment, funding levels of the defined benefit plans will continue to be challenged. The challenging macroeconomic environment increases the risk that sponsors will be unable to meet the cost to provide the promised benefits. And sponsors will have a number of choices in those circumstances. They could wind up the existing current defined benefit arrangement, or you could have a conversion to the defined contribution or some hybrid arrangements. Going forward, the central bank will continue to monitor this particular sector. This brings us to the vulnerabilities and the risk assessment. Remember the previous slide where we looked at the international scene. We are now customizing this to the domestic scene. And this is the vulnerability and risk framework. This was used in 2016 and is continued to be used in 2017. So I'll just briefly run through what we consider to be the vulnerabilities. Well, a vulnerability is essentially a weakness in the financial markets or infrastructure or institution that leads to a buildup of financial imbalances. So the imbalances, we will later discuss this in some more detail. Then you have triggers, which are shocks that result in significant materialization of the imbalances, or you may have disruptions to the financial services. These pass through the financial sector and the real economy through channels, and the channels we speak about is the interconnectedness. So interconnectedness could be a benefit, but it also could be a challenge to us. We then look at a risk assessment, and doing the risk assessment, you look at the probability and the impact, and we look at the different levels of risk. So far, we have 5 levels ranging from low to very high, and it all has this feedback looping effect. So let's look at the domestic financial system. So based on that framework, we identified a number of vulnerabilities. So we have identified 3, and I'll be discussing only one of them. The remaining are discussed in the Financial Stability Report, which is on the website. So the vulnerability, the high household indebtedness, high sovereign concentration in the financial sector, and relatively low domestic interest rates. What are some of the triggers that could make these vulnerabilities more significant or lead to any disruption? So when we look at a high household indebtedness, we speak to rising interest rates and variable rate mortgages. What are the contagion channels? Deterioration of the household's balance sheet, and the risk is deterioration in the quality of the consumer loan portfolio held in the particular banks. And the risk assessment, we consider that to be elevated. We look at the high sovereign concentration in the financial sector, the trigger credit rate downgrades, rise in debt, sovereign debt impairment. Again, we look at it as elevated, relatively low domestic interest rates. Again, the financial market volatility, increased pressures, and on. So we consider this to be volatile as well. So the one that I'll be discussing with you this morning is the high household debt. Our nation is not the only one grappling with this problem. If you recall, in my review of the global financial stability risk, household indebtedness was the cause of concern around the world, in Europe, in the United Kingdom, and Canada, to name a few. In Trinidad and Tobago, the rapid buildup of household debt has resulted in a substantial debt load on the household's balance sheet. The total estimated household debt stood at $53.2 billion, with the majority of that related to real estate and consumer loans. So if you look at what we have on the screen, you would realize that if you look at a typical household, it will be a combination of real estate mortgage, which is probably the primary expense that you have on a monthly basis. Then you have a motor car loan or motor car loans, then credit cards. But an interesting feature is that we are seeing, especially around 2017, that there has been some refinancing and consolidation of debt. But this is only 4 billion out of a total of about 32 billion. So it's nothing to be concerned. It means that the households are recognizing that they need to readjust their portfolios to cater for potential triggers in the market, whether it is unemployment or rising interest rates and other things. So we have an educated consumer, and they have been adjusting their portfolio in order to be ready for whatever comes along. When we look, so I explained to you that the household debts were 53 billion, and the banking sector had an exposure of 32 billion. This represented 24% of the total banking assets. And as I mentioned before, the distribution. So what happens if a trigger stemming from the real or the financial environment? For example, if we had prolonged differences, how would the households react? And if you see the bottom of the slide, it said the magnitude of the credit shock to the banking system is not only dependent on the level of debt, but also the consumer resilience in the face of the triggers that could affect their debt servicing capabilities. So we're seeing that they started to adjust. We know from the banking sector their credit underwriting standards are robust enough so that they have some sort of room before it becomes a real problem. But it is something to note, and it has been the issue internationally, and we have the issue domestically. This issue was raised in the previous report in 2016, and it continues to be relevant in our situation. I'd like to leave you with some of the key messages. The financial sector vulnerabilities and risk has not changed significantly from 2016. So it means that we continue to be robust and resilient. Even though we have seen certain triggers activated, the domestic financial system continues to be adequately capitalized with robust asset quality, relatively stable profit, comfortable liquidity as seen from the various financial soundness indicators. We have also seen the rapid financial globalization has been accompanied by financial interconnectedness, interconnectedness. While being interconnected is beneficial, you could have challenges, and this should be carefully monitored. We recognize this is an ongoing process, so therefore addressing underlying financial system vulnerabilities is a long-term endeavor which requires responsiveness, persistence, and practicality. The central bank will continue its ongoing assessment of the economic and financial system and will continue to take regulatory and supervisory initiatives to safeguard financial stability. Thank you, ladies and gentlemen, for your undivided attention. At this point, I would like to introduce the Deputy Inspector of Financial Institutions, Ms. Michelle Francis Panto, to continue the discussions with you. Thank you.
Thank you, Patrick. Good morning, ladies and gentlemen, all protocols observed. Today I will be presenting on the regulatory and supervisory issues associated with cryptocurrencies. In the past few years, financial technology, or fintech for short, has captured the world's imagination by offering alternatives to traditional means of payment. Experts generally agree that cryptocurrencies do not possess all the attributes of money. However, there is consensus that the underlying technology, distributed ledger technology, when mature, has the potential to transform payment services by removing the need for a central intermediary such as a central bank. The Swedish central bank governor, Stefan Ingves, has pointed out that at present, only 13% of transactions in his country are settled in cash. If banknotes and coins have had their day, in the future the public will no longer have access to a state-guaranteed means of payment unless central bankers redefine their role. In this regard, central banks have been considering whether they should be issuing their own digital currency. However, this narrative is still being written as central banks carefully consider the implications of a central bank digital currency on monetary policy and financial stability. My presentation today is as follows. I will discuss the terminology around digital currency and cryptocurrency, what is a distributed ledger or blockchain, the pros and cons of cryptocurrencies, the regulatory response to digital currencies. I will also look at what is a central bank digital currency, and in concluding with our look at our regulatory approach. The definition of virtual currency is still evolving, and terminology varies from digital currency, virtual currency, cryptocurrency, crypto asset, and crypto token. During my presentation, I'll be referring to virtual currency, cryptocurrency, and crypto assets interchangeably. It is recognized that the term digital currency can refer to all forms of electronic money or e-money, which is a digital representation of fiat money, and cryptocurrency or virtual currency, which is a digital representation of non-fiat. One of the more popular definitions of virtual currency was coined by the Financial Action Task Force, or FATF, in 2014, and refers to virtual currency as a digital representation of value that can be digitally traded and functions as 1, a medium of exchange, and or 2, a unit of account, and or 3, a store of value, but does not have legal tender status. It is neither issued nor guaranteed by any jurisdiction and fulfills the above functions only by agreement within the community of users of the virtual currency. In addition, earlier in 2012, the European Central Bank defined a virtual currency as a type of unregulated digital money, which is issued and usually controlled by its developer and used and accepted among the members of a specific virtual community. The advent of cryptocurrencies was made possible through the use of distributed ledger or blockchain technology. Although sometimes used interchangeably, they differ in that every blockchain is a distributed ledger, but not every distributed ledger is a blockchain. What then is a distributed ledger or blockchain, and how do they work? A distributed ledger is a database that is spread across several nodes or computing devices. Each node replicates and saves an identical copy of the ledger. Each participant node of the network updates itself independently. The groundbreaking feature of distributed ledger technology is that the ledger is not maintained by any central authority. Updates to the ledger are independently constructed and recorded by each node. The nodes then vote and agree on the updates using a consensual algorithm. And once consensus has been reached, the distributed ledger updates itself, and the latest agreed upon version of the ledger is saved on each node. The structure of the blockchain makes it distinct from other kinds of distributed ledgers. Data on the blockchain is grouped together and organized in blocks as shown in this diagram. The blocks are then linked to one another and secured using cryptography. As illustrated, a blockchain is essentially a continuously growing list of records. Its structure only allows data to be added to the database. Altering or deleting previously entered data on earlier blocks is impossible. Blockchain technology is therefore well suited for recording events, managing records, processing transactions, and tracing assets, and has the potential benefit of lowering the cost of international payments and remittances and financial disclosure, which I will discuss some more later on. A key difference between cryptocurrency and fiat currency is its legal tender status. As apart from Japan, cryptocurrency is not considered legal tender as it is not government issued. Other differences include there is no central intermediary, so it is not a liability of anyone. Fiat currency is backed by a central bank or central authority. Its decentralized nature. In a centralized system, there's a group of people responsible for the state of the whole system. If you made a mistake in a transaction, you can make a request to an entity and rely on a successful outcome. You cannot do this in a decentralized system. It is unregulated, which poses consumer protection concerns and makes it less secure than fiat currency. And it exists only in digital form. There is no physical equivalent. Given that cryptocurrencies can be used to make payments, then a good question is it money? The gurus among us would say that it is not money, as it does not possess all the key attributes of money. As a medium of exchange, it is still not mature enough. Globally, cryptocurrency has not been widely used or accepted as a means of payment. I believe currently Japan is the only country that has legally allowed it as a payment option. The high price volatility associated with cryptocurrencies is affecting their ability to serve as a store of value. Former US Federal Reserve Chair Janet Yellen described Bitcoin as very speculative and not a stable source of value. Further, as a unit of account, it is also lacking, since the prices of most goods and services are quoted in fiat. Where they are valued in cryptocurrency like Bitcoin, it has to be converted using exchange rates to determine the value in relation to the fiat currency used. In light of these issues, within the regulatory community at least, the terminology of crypto assets or token is considered as more appropriate than cryptocurrency, at least for the time being. Notwithstanding, there are many benefits to be derived from cryptocurrencies. Such benefits include privacy due to the anonymous nature of the transactions, efficiency in terms of lower transaction cost and faster processing time. It is also viewed as a solution for reaching the unbanked, and as such can help to promote financial inclusion. Additionally, some believe that it may serve as a solution for addressing the de-risking issue. However, this is yet to be proven. On the other hand, cryptocurrencies pose several risks. It's interesting to note that while anonymity may be a benefit for users of cryptocurrencies in terms of privacy, it presents a regulatory risk due to its potential to be used for illegal and illicit activities on the dark web, such as narcotic sales, ransomware payments, money laundering and terrorism financing, and human trafficking. Some countries have tried to address this by putting anti-money laundering, counter-terrorism financing measures in place at the level of virtual currency exchanges. Further, cryptocurrencies are very volatile, and individuals holding them can realize significant losses in value of their holdings, as seen over the last year, when, for instance, the value of Bitcoin started off at 1,000 US at the beginning of 2017, rose to 20,000 by mid-December, and then plunged to 6,000 in January of 2018. Consumer protection is non-existent. Given the regulatory uncertainty or the unregulated nature of cryptocurrencies, there is no recourse or consumer protection in instances when the cryptocurrency exchange is compromised or hacked or the cryptographic keys are lost. Moreover, errors in virtual currency transactions cannot be reversed. Unlike credit cards, consumers have no right to reverse the changes if something goes wrong. Further, its unregulated nature means that anyone can issue a virtual currency, and as a result, a number of Ponzi schemes have emerged, such as in China, for example, causing that country to close all Bitcoin exchanges. More recently, environmental concerns have emerged given the vast amount of computer power and energy consumption required to mine Bitcoins. The head of the IMF has referred to this as an environmental disaster. Additionally, a key concern of regulators and central banks is the impact of cryptocurrencies on financial stability. Mark Carney, who is the chair of the Financial Stability Board and the governor of the Bank of England, addressed the impact of cryptocurrencies on financial stability quite frontally in his March 2018 speech to G20 members. He stated that the FSB's initial assessment is that cryptocurrencies do not pose risks to global financial stability at this time. That is in part due to their relative small size. This is in part because they are small relative to the financial system. Even at their recent peak, their combined global market value was less than 1% of global GDP. In comparison, just prior to the global financial crisis, the notional value of credit default swaps was 100% of global GDP. Their small size and the fact that they are not substitutes for currency and with very limited use for real economy and financial transactions has meant that the linkages to the rest of the financial system are limited. He noted, though, that cryptocurrencies raise a host of issues around consumer and investor protection, as well as their use to shield illicit activity and for money laundering and terrorism financing. At the same time, he acknowledged that the technologies underlying them has the potential to improve the efficiency and inclusiveness of both the financial system and the economy. Having regard to the risk posed by cryptocurrencies, which I spoke of earlier, jurisdictions around the world have taken a variety of positions on the regulation of cryptocurrencies, as this map shows. Many countries are still determining their approach to virtual currencies. Several have initially issued public warnings against buying, holding, and transacting in them from a consumer protection perspective, while some have implemented targeted regulations. Others are still undecided in their approach and are allowing it to operate in their space without any regulations. And a number of countries have instituted a regulatory sandbox programs, which is a framework established by the regulator which allows fintech startups and innovators to play in a controlled space under the regulator's supervision. So although currently shown here in red, that is Russia, as making cryptocurrencies illegal, the Russian authorities are planning to pass new legislation to legalize cryptocurrency markets by July 2018. China is restrictive in its approach and has placed bans on cryptocurrency payments and exchanges and initial coin offerings, or ICOs. Japan and Singapore have taken a more accommodative stance, but have introduced AML regulations for the exchanges, with Japan the only country to classify virtual currencies as a legal payment option. Japan and Singapore have also established regulatory sandboxes. In the UK, cryptocurrencies have been allowed while the authorities undertake research to better understand the innovations. In the US, cryptocurrencies and ICOs are not banned, but their treatment varies from state to state. In Latin America, Mexico has already established fintech law, while others are still monitoring and researching these fintech developments. Regionally, the response is just as varied. Some Caribbean jurisdictions have issued advisories, such as Aruba, Belize, Curacao, and St. Martin. ECCB, Jamaica, and Trinidad and Tobago has issued some warnings in terms of ICOs. Barbados is also preparing to issue an advisory in 2018. For many, financial sector legislation do not explicitly cover cryptocurrency. But for some, there is some scope under legislation covering payment systems or remittance businesses. Many central banks have also taken a wait-and-learn approach, not wanting to pronounce too early on a regulatory stance. And some central banks, at least 3 of them, have indicated their intention to issue a central bank digital currencies, and others are assessing. Just a minute. Given the rapid evolution of financial technology and the lack of interoperability among networks, trust issues around the issuers of virtual currency, and a desire to maintain control of the monetary policy, many central banks have been exploring the benefits of issuing a central bank digital currency, or CBDC. CBDC is potentially a new form of digital central bank money that can be distinguished from reserves or settlement balances held by commercial banks at the central bank. There are various design choices for CBDC in terms of access, whether wide or restricted, anonymity, complete or none, operational availability, 24/7 or limited, and interest-bearing or not. Depending on these design choices, there can be potential benefits and risks. However, the real innovation would be to make the central bank digital currency universally accessible using some sort of distributed ledger as a wholesale CBDC, that is with the commercial banks, already exist in a form. As such, the Bank for International Settlements has cautioned that central banks should undertake careful thought and comprehensive research in keeping with countries' circumstances. Sweden, Britain, Canada, China, and Singapore, and nearer to home, Bahamas and the ECCB are among those considering CBDCs. Within the Caribbean region, some jurisdictions have been open to exploring a central bank digital currency as a potential solution to treat with the de-risking by correspondent banks and fostering financial inclusion. So by now you may be asking, what is the Central Bank of Trinidad and Tobago's regulatory approach to cryptocurrency? And I would say I was leading up to that. To date, the Central Bank's regulatory stance has been accommodative and collaborative, but cautious. We have been monitoring the developments on a continuous basis, and several key areas in the bank are involved in this, including Payment Systems Oversight Division, our IT, personnel, research, and our legal departments. A virtual currency policy has been drafted, but has not yet been ratified, as we are awaiting the outcome of key work streams, which I will discuss in a minute, before formulating our position later this year. To explain more broadly, I describe our stance as being accommodative in that the central bank has not banned or restricted cryptocurrency, although I would have cautioned users against investing in cryptocurrencies last year due to the fact that they were very volatile. Earlier this year, though, the Trinidad and Tobago Securities and Exchange Commission and the government would have issued warnings around initial coin offerings, or ICOs. We have been collaborative in that we have been engaging domestic, regional, and international regulators in our pursuit of a regulatory stance. Currently, there's a Caribbean FinTech Working Group and a SEMLA FinTech Forum and a Caribbean Economic Research Team, which are looking, all of these different work streams are looking at various aspects of research in terms of regulating and addressing digital currencies. The central bank is heavily involved in all three of these areas. Additionally, next month, the central bank, in conjunction with CARTAC and the SEMLA, will be hosting a regional conference on cryptocurrencies and central bank's regulatory response. We have also been collaborative in that we have been engaging with fintechs to discuss their business models and their risk management processes. Cautious in that we continue to scan the environment and monitor developments, since we are aware of the potential risks, particularly money laundering and terrorism financing, cyber risk, and the lack of consumer protection. In this regard, while our law is imperfect, there is scope for regulatory oversight of fintechs depending on their activity. To this end, in September 2017, we would have issued a public notice advising of central bank's responsibility for oversight of payment systems and remittance business. Consequently, fintechs whose proposed activities include payment services or electronic money have been engaging with us. In closing, Christine Lagarde, the Managing Director of the IMF, in speaking of a regulatory approach to fintech in the June 2018 Finance and Development Journal, has summed up the regulatory dilemma regarding cryptocurrencies, and I quote, "On the one hand, they, and by they I mean regulators, must protect consumers and investors against fraud and combat tax evasion money laundering, and the financing of terrorism, ensuring that the risks are thoroughly understood and managed. They must protect the integrity and stability of the financial system. On the other hand, they must be aware of stifling innovation that responsibly and sustainably benefits the public. I thank you for your attention and now invite the Governor to deliver his remarks.
Thanks, Michelle. Thanks, Patrick. Thanks, Nicole. Good morning, ladies and gentlemen. Welcome to the Central Bank of Trinidad and Tobago. I'm quite impressed to see so many of you here, given the rain and the football. But I hope your day is going very well. I had a great start to my day. This morning, I went down and saw my alma mater, Nelson Street Boys RC School. They're having their graduation ceremony in our auditorium. And I met the principal, I met some of the teachers. It was really beautiful to see the parents and everybody gathered together in this occasion. So it really brought back to me some very happy childhood memories. It also brought home to me the importance of what we are doing, and what I mean by we would be all of us in this room, all of us listening to us online or in your homes across the country, the importance of pulling together, working 100% to secure a strong future for these boys, because they are boys, you can't even call them young men, and for all the children of our nation as a whole, because they depend on us. And you know, we have to do our best to make the future bright for them. And we cannot let them down. So it's a good start to my day. So what am I going to do? As Nicole said, we at the Central Bank are focusing a lot on communicating as succinctly, precisely, and as effectively as possible what we do, what we analyze, how we come up with what we think, and to be able to share with the country and international observers how we think about things. And hopefully this will add to the debate. So we are evolving. In this regard, a couple of years ago, we had been having the launch of the Monetary Policy Report and Financial Stability Report separately and so forth. And we will still continue to have the Monetary Policy Report launch in November. But we had the two of these reports, the MPR, which is the Monetary Policy Report, and the Financial Stability Report, FSR for those who like acronyms, very close together. So we decided, let's have one launch today. On Friday, Thursday, we would have published on our website the Financial Stability Report. The Monetary Policy Report. But today what I want to do is to kind of bring the macro together with the financial stability aspects, because clearly the financial system, as was well demonstrated and explained by both our presenters before, Michelle and Patrick, it is important, but it operates within a context. So the macroeconomy affects the financial system, but there is also a movement from the financial system to the macroeconomy. So we have to look at them together. But I don't want to spend the time just recounting every single detail in the Monetary Policy Report. I'll just give a flavor of it and then try to link it to what is happening in the financial system and what we at the Central Bank are doing. And again, in terms of making things easy for you, we've distributed the PowerPoint presentation so you could look at it, and those of you online can look at it at your leisure also. And what I want to do is to really focus on 7 simple points in my presentation. So I won't go into too many details, but these are the 7 key points that I want to make. And I'll bring them up at the end also that you could see it. The first thing would be the international setting. Point 1, that global economic prospects have strengthened, but there are serious concerns about increasing protectionism. When you go to all the IMF meetings over the last let's say, year or so. You know, they have annual meetings, they have spring meetings. The general consensus is that growth is a fact of life now. We've gone away from the days of the problems with the big financial stability issue, and growth is upon us. And it is actually gathering serious momentum. And this is very good news for all concerned. And the latest IMF report shows that growth has actually been revised upward, global growth to about 3.9%, up from earlier reports. And this is pretty much broad-based across countries, across the emerging market, developing economies, across the advanced economies, etc. So this is very good news because it affects how we could be able to export any country and so forth. It affects the whole transactions and so. And a lot of this growth has actually been based on trade. So trade had been picking up. And again, this is part of the good news. However, on the other side, we would notice, and many of you would be aware that you have some looming problems in the international trade setting, particularly between the United States and China. A virtual tit for tat has been coming on our shares, and you know, one is trying to, you know, outshine the other one in terms of you know, the toughness of its measures. This is important because it affects not only the trade between China and the US, but it affects the whole global trading system. Because what we want, ideally, is a global trading system that is based on predictable rules and that affects everyone equally. So you could have smooth flow of traffic, trade across borders. But when you have two big powers duking it out like that, you could have difficulties in what happens eventually. So it's something that we have to watch very carefully. It would not only affect Chinese steel or US exports to China and so, but it could spill over to other things. It could affect the whole international trading system as well as the geopolitics, because once you have that, then other things come into play. So we want to be careful about that and hope that a plethora of price and non-tariff barriers do not become a feature of life in the global system. But you also have to look at the financial stability front. I'm still on point one on the global system. And again, there's good news on the financial stability front because we have a lot less volatility in international financial markets. We had a blip sometime in February, but we are somewhat over that. And equity markets have been performing quite well. If you look at the chart on the left, you'll see a lot of global equity, is a lot of action taking place, and there's great confidence there. So this is, again, a good part of the news that had been emphasized by the fund and many other observers elsewhere. But of course, we have to be careful. There wouldn't necessarily be bumps along the road. And the picture had been painted before was of the global system. But of course, you have different pockets of action, different regions, and things would affect countries differentially. For example, even on the trade side, you may have commodity exporters facing difficulties here and there, depending on the region, depending on the politics, and so forth. And similarly, in the financial system, we also have to be aware of things that are in the short term, but are also looming on the horizon. For example, as was mentioned before, issues of credit quality in some regions. You know, in China, there's a lot of concern about certain credits. Crypto assets, as Michelle had been spending a lot of time on, what does that mean? A lot of these things, is it going to affect problems in the Bitcoin market, going to spill over into lack of confidence elsewhere? Interest rates hikes, we'll talk about that a little more in detail because it affects us directly, but the pace of unwinding of stimulus by the US, as well as the pace of hiking of interest rates are very important. And there is a concern generally that too rapid a pace of hiking of interest rates could be destabilizing, because for countries that have grown used to the interest rates being at very low levels, it could be very difficult to then get used to a different world, one, as well as it could lead to capital movements, because to the extent that interest rates are high in one region, it would tend to pull capital in that direction. So you have to be concerned about that, and of course the flip side, the effect on the configuration of global exchange rates, particularly in developing economies. Higher market volatility, as I said, we had something in February. Anything could happen. You just have to be aware. And house prices, again, this is as one proxy for asset prices in the world. So you have to. So some of these, the first point I made, just to summarize again, good news, but you have to be aware of the trade issues as well as on the financial front, other things that might come. So moving along to the second point. So we go from the external to what you are really here for, the domestic side. What is happening domestically? The first thing is that the energy sector is rebounding well. We have seen the numbers. We looked at the numbers, and you know why. Gas production since August 2017 has been up, and it is seeming to be a good increase, a solid increase that will persist for a while. So if you look at the chart below the left, left for you, left blue chart, you would see the natural gas production, the juniper fields and other investments that are bearing fruit. So this is very good news. Crude oil production has not been taking off as much, so you see it's a little more jerky. But the natural gas output increase has been important because it does affect not only the output of natural gas and the earnings from that, but also, and probably more importantly, the effect on downstream production, downstream industries that were suffering from shortages. So methanol production is up, and fertilizer production is up, and so forth. So as I said, I won't go into all the numbers. I'd leave a lot of those details for you to read the report, and then of course in the fun section of the launch today, which is the question and answer. I'm sure you'll ask a lot of questions on these. But you have the downstream production has been picking up because of natural gas, and we have on the crude oil side, as I said, less action. So this is important because we are still in a situation where the energy sector is a big part of our economy. So once the energy sector does well, it affects other parts of the economy, which I'll get to in point 3. But the second part of point 2 is that the domestic production has clearly been supported by the international side, which is the commodity prices that are relevant, particularly for us would be oil and natural gas prices. So contrary to many expectations, oil prices have been very, I don't know what adjective you want to use, whether buoyant or high or whatever, but at some point they slipped over $76. Now it's about, the latest number I have is probably about 65. This is WTI. And this is important because the government's budget, which I'll talk about in a little while, had been pegged at $52. So you could actually find that you may have got a mini windfall then from the fact that oil prices have been higher than budgeted. Of course, we know that production of oil is one aspect of government revenue, and a lot of it is dependent on natural gas. Natural gas prices have also been buoyant, not as over budget as oil, but still in that range. So we see natural gas prices have also been above budgeted levels. And the short-term forecasts are that you would still have a continued steadiness of oil prices above earlier budgeted levels, so around the $60 mark potentially for oil, and around 2.5, it's now about 3 now, MMBTU for gas. Of course, we have to say, well, all right, well, this is the short run. What happens in the long run? I suppose most of us and many economists and everybody has been confused as what actually happens in oil prices, and it's quite volatile. So you put something and then prices plummet, you put another thing and prices go above it, you know, you never could be sure. So you have to be aware that there is some volatility. So although the short-term prospects are for the oil prices to be buoyant or to stay afloat, as it were, we still have the issues of the longer term. And we have competition from shale oil. We have new energy sources that are coming into being. And we have the move away from fossil fuels. So I think those would argue for a softening of oil prices over time. But again, we accept the good news, and we think that the country could definitely benefit from that in the short term, particularly as it affects the balance of payments and the fiscal situation. But of course, certainly at the central bank, we tend to be very, I wouldn't say pessimistic, but very conservative. So we like to say, well, it may come up, but let's not get overly excited. All right, so this is the second point on the energy side. But let's go into the non-energy side now, because non-energy is a bigger part of the economy over time. Previously, the oil is still dominant, but over time, non-energy activities have been taking their place. Now, what would we anticipate? We would anticipate that as the oil sector grows, you will have a spillover effect to the non-oil economy. So far, we have not seen much evidence of that. Let me use one example on the construction side. If you look at the graph, you will see one is local sales of cement, which is the reddish-orange one, and then mined aggregates produced, which is the bluish one. And they have actually been coming down over time. So what that suggests is that the need of the sector for these inputs has been slipping. And this is one important indicator that we use to see what is actually happening. So local sales of cement and mined aggregates fell. Even in the first quarter of 2018, local sales of cement by about 4.2% and mined aggregates by about 4.6%. And then we look at other indicators. We say, well, let's look at the prices. We find that the producer prices for cement and concrete have declined, and there have been marginal increases in the overall prices for building materials. So that also gives you a sense of how much action there is. I remember in the 1970s, it was, you know, prices were going through the roof, literally, because there was so much action, so much thing going on that construction prices were just, you know, blowing up. Then let's look at something else. We look at employment in construction. And when we look at the latest numbers, which is the latest numbers for overall employment is 5.3% in the second quarter of 2017. That's the latest data we have. And we drill down into the construction numbers. We see that has the highest unemployment rate of 11%. So this is not insubstantial. Then we go even further and say, well, what about financing for construction? And we saw that there was actually a 7.7 decline in lending to construction firms in the first quarter of 2018. So all of these paint a picture that one important sector of the economy on the non-oil side still has not responded to what is happening on the energy side. However, there are positive signs we see in certain other areas, in retail trade, business financing. Some of the indicators we use for retail trade are showing some upturn. New car sales are up, I think, by about 15% between the first quarter of 2017 and 2018. And retail sales seem to also be gathering momentum, but slowly. There are also some encouraging signs of a pickup in financial system credit to businesses as a whole. Because to the extent that businesses feel confident, then they would be able to leverage themselves more. The banks would be able to lend to them and so forth. So it is a sign of confidence that they would be able to, both the borrower and the lender are comfortable with the capacity of the debtor to repay. And that would be depending on what they're going to get in the future. So we have seen after some time when overall credit was in negative territory, a kind of over the last few months, a steady increase in credit in all areas in particular, but especially for our purposes, business credit. So we don't know how sustained that would be, but I think that is a sign that there may be something happening there, a leading indicator of things to come. So that business credit has grown by about 4.3% in April 2018, consumer credit around 5%, and real estate credit has actually been quite buoyant, about 7.7%. So this is the situation on some aspects of the non-oil economy. I mentioned construction. I'm not going into all of them, but construction, new car sales as a proxy for distribution, credit issues. So what eventually will happen? Well, of course, we don't know. But looking at later on this year, we think that the pace of recovery of the non-energy sector will depend in large measure on the speed of execution of the public sector capital program, because of course that is a direct pull for construction activity, but it also has spillover to other construction areas, as well as the responsiveness of the private sector. To the extent that the private sector feels comfortable, and they will have to talk to the businessmen and get a sense of what they are thinking, then they would be more prone to invest and take advantage of things that are coming out. So we wait to see. So it's a mixed picture on this side, but certainly on the energy side, we have some good news. Let me go to point 4. The fourth point is about the fiscal situation. And you would have had a lot of the details in the monetary policy report that were reported in the papers, and the minister would have explained the situation and so forth. So I'll just recap it very, very briefly. And the data for the first 7 months of the fiscal year, which should be October to April 2018, October 2017 to April 2018, show that the fiscal accounts have improved. A combination of higher revenue and lower current expenditure led to a lower deficit in the first 7 months. And there's a quite large difference, 2.9 billion in the 2017-18 period compared to about 9 billion in the 2016-17 period. Why was this? Partly as I said, on the revenue side, based on the oil prices, the energy prices, energy production, then you would have had some tax changes, some timing issues and so forth, and perhaps some buoyancy on non-energy, the base of non-energy revenue. On the expenditure side, we had goods and services, transfers and subsidies, salaries and wages. Some of the transfers and subsidies related to less need for the energy subsidy, as well as on the salaries and wages side, you didn't have to pay back the arrears. The arrears were catered for in the earlier period. And capital spending has been about more or less the same. The Ministry of Finance estimates also that the whole year outcome of the fiscal situation would also be less than the original budget. So this is the fiscal situation. But let me look analytically at what it means. And if you look at the graph, you would see over it takes it from 2010, around 2010 to now, and you would see revenue, expenditure, and so forth. The main thing is the dramatic red line, which shows the fiscal deficit. Now, the upturn in the red line is suggestive that you would have a lower fiscal deficit, as I was explaining, projected for this year. But in the short term, you are still expected to have expenditure being more than revenue. In other words, a further deficit. What does it mean? it means that you have to find some way of financing this deficit. And I think this is important to be aware of over the medium term. Because as you know, in your own personal circumstance, you could be spending more than you earn for different reasons. I mean, it may not be recklessness, but it could be, you have to buy a house. You don't have enough money to buy a house. So you borrow money to buy a house, borrow, to buy a car, all this sort of thing. How would you finance that? You could finance it by selling something that you have, or you could finance it by earning more income over time and so forth. So let's look at the 4 sources of financing and try to figure out or try to get some lessons as to what we would have to be looking for. The first source is asset sales. So a country or an individual, you spend more than you earn. You could start to sell the furniture, or you could start to sell something or whatever. The furniture that you don't need, not that you bed or something, but you have excess, whatever. So this is good because you could be disposing of things that you have, but it may be one-off. You can't depend on it over time at some point you won't have anything to sell. So this is important to know when you are building the financing of a budget. And I think it has been useful for the government to rely on asset sales, but you would know that over time this cannot be a persistent feature. So that in itself is something to be aware of. The second thing is external funding. External funding, as was mentioned before about capital markets, you have to look at the capital markets. Well, it could be private, it could be multilateral. We have borrowed from the CAF, which is Corporación Andina de Fomento, which is the Latin American Development Bank. When you borrow externally, it provides needed resources, including of foreign exchange and so forth. But of course, you have to repay. So when you have to be thinking that it fills a hole, but you also have to be thinking that it is not permanent. It has to be repaid. So this is one thing that you need to be aware of. The third thing that a country or government may do is to borrow from the central bank. Borrowing from the central bank should really be a temporary phenomenon. Temporary, very short term, and repaid quickly, because it has monetary and inflationary implications. And I had discussed that in my last presentation. I think it was in November. So it's something to be aware of. The fourth thing is on the domestic side, outside of the central bank. You could borrow from the banks, from the public, and so forth. Again, this may be useful, but one always has to bear in mind that it affects your debt profile clearly. And depending on the size of it, it could lead to crowding out. Crowding out meaning that people borrow or lend to the government as opposed to lending to the private sector. If you have too much of that, then businesses are starved for credit. I don't think we have that issue now, but it is something to be aware of. And as Patrick was mentioning, the issue of sovereign debt exposure of financial institutions and others. So the point I'm making on this chart is looking to the future. When we look at the fiscal situation and we look at how it is going to be financed, we have to look carefully at the different options for financing and then weigh the pros and cons of it and balance it and determine what to do. It is quite important because it affects everything. It affects your debt service. It affects how much you have to spend on interest payments as opposed to education or so forth. So it is quite important to be aware of it. So ultimately, and the last point I'm making is that you should have continued fiscal consolidation is necessary towards a balanced budget. And I think the plans are to reduce the budget to zero after in a couple of years. And I think the momentum needs to continue to avoid a buildup of debt. And that is a simple point I'm making on that. So let me go quickly into point 5, which is on the foreign exchange side. Now, recent higher energy export values, meaning because of the prices as well as the volumes have helped in some of the inflows of foreign exchange. Now, if you look at the purchases, I'm talking about purchases of foreign currency by authorized dealers from the public. Public meaning outside of the central bank and outside of the other financial institutions. This has grown, and it's not that much, but let's say between January and May 2017, it was 1.4 billion. And between January and May 2018 is 1.6 billion. So about a couple hundred million more. But it is a reversal of what had been happening before. And it could portend that this will continue. We're not sure yet, but at least you have seen some increase in inflows. On the sales side, however, the sales have been fairly steady, about 2.2 billion in those similar periods. What this has meant is that the central bank has intervened meaning that the central bank's sales of foreign currency to the authorized dealers has been less than before. So in January to May 2017, it was 810 million. And in January to May 2018, it's 645 million. So it's 165 million less because there's some increase in inflows there outside of the central bank. But clearly we know that the situation is not fully in equilibrium and work needs to be done. And if you look at the chart on the right, you will see the implications of where we are now for the international reserves. So international reserves have declined, and for the year so far, at the end of 2017, reserves were 8.4 billion, about 9.7 months of import cover, and in mid-June, 7.9 billion, which is about 9 months of import cover. So we've lost about 500 million in official reserves, which is not insubstantial. But the fact is that we do have a substantial stock of reserves by any metric, whether you want to use import cover, 9 months of import cover is high. Other economists, IMF, whatever international analysts use ratio of import of reserves to broad money or external debt and so forth. We are still very comfortable. But of course, we can't be complacent because we still have an imbalance and we still have the future to be aware of. So here is where our perspective on the foreign exchange market at the central bank is that restoring durable balance in the foreign exchange market requires an important combination, and it's of appropriate combination of fiscal, structural, and monetary policies. And this is a point I'd emphasized even in the November presentation. So that we anticipate that despite the recent improvement in inflows, there will be some imbalance in the foreign exchange market, and it is likely to persist over the third quarter of 2018 as the economy continues in adjustment mode, because we are still adjusting to the realities of the lower oil prices, even though prices have gone up now, but from 2008, 9, so forth, we have been facing that. And so we're still working through that. So we are still in adjustment mode. And we anticipate that the imbalance, at least in the foreign exchange market, would likely persist over the third quarter of 2018. And as I said, restoring a durable balance requires coordinated and appropriate fiscal, structural, and monetary policies. Why? Because on the macroeconomic situation, you have to look at anything that affects demand and anything that affects supply. The fiscal position is major because it's a major direct, it has a direct impact on demand, but also indirect through the role of the government and so forth. So you could have a tight fiscal position affecting or contracting demand and therefore contracting imports. There's one thing. Monetary policies can be complementary. Again, we'll talk about that shortly, about interest rates and so forth, but they need to be coordinated. I'll just emphasize now on the structural side. What do I mean? The structural side is how things operate. How do you comport yourself as a nation to deal with things, and what are the infrastructure and institutions and everything to make you efficient, to make you effective, and to make you productive. And we think there's a lot of work that still needs to be done in that area to make the economy smoother, more reliable, more efficient, and more ready to deal with challenges. For example, on the legislative side, the institutions, the attitudes, technology, modernization of standards, strengthen accountability, and so forth. I won't go into it in detail now, but if you have reforms that could build all the capacity in those areas, then you find that you could respond to things much more easily. I'll give the example that I did at the last occasion. And it is based on an IMF study where they looked at, in Latin America, the impact of a sharp currency depreciation. What they found is that you may have restored external balance. In other words, the foreign exchange market may have gone back into equilibrium because of the sharp depreciation. But how? Mainly at the cost of import compression as opposed to export expansion. And that is not the mix that you really want. Compared to, let's say, in Asia, where the markets are so flexible and the institutions are so aggressive that if you have even a small currency movement, then exports increase very rapidly because they are geared to take advantage of any price advantage that they have. So it's something that we have to be continually aware of, and I think there's a lot of room in our society for improving the way of doing business, the way we approach things in order to get the best out of any reforms that we have. So let me go into the second to last point, which is on monetary policy. And just briefly, I'll give you the considerations that we use in terms of monetary policy. Clearly, we look at inflation, we look at all the monetary conditions, including credit, liquidity, excess reserves, as Patrick was talking about, what is happening on the output side, energy output, non-energy output. And we also look at the external side, which is like the interest rates that we charge, interest rates in Trinidad and Tobago, compared to the interest rates abroad, because that would affect the attractiveness of your assets compared to another country's assets. So just more precisely, if we look at each of them in turn, we say inflation has been very, very low, 0.8% in March 2018. We see that private sector credit has increased, as I was telling you, 6.1% in March, and has been growing. In terms of excess liquidity, excess reserves averaged about $2.5 billion from January to May 2018, so excess reserves are comfortable. We've seen that the energy sector has also continued to grow, so that if you were to look at our indicator, it's about 9.3% expansion in the first quarter of 2018. On the other hand, we see that the differential between the US interest rates and our interest rates has actually turned negative. So that about 74 basis points we have that our rates are lower than US interest rates. So it is something to be aware of. Taking all that into account, what the central bank's action has been is to keep balancing all of these things, to keep our main interest rate, which is the repo rate, steady at 4.75% for quite some time. So that was the last action in March, I think it was. So let's see but that's in the past now. Let's see what happens in the future, and what are the things that determine our perspective. And we would see, as I was talking about, the balancing, the juggling, the pendulum, whatever you want to call it, where we have the domestic factors. The P dot is inflation, for those of you like those kind of things. Y dot would be your activity or income, GDP, and so external factors, the interest differential. R would be ours, R star would be external, and R star E would be the expected foreign rates. So just briefly on the domestic side, we see inflation, we don't see an inflationary issue per se at this stage, and we see that growth may be coming forward, or it's still incipient, but there are tentative signs there. So you have, something on that side. But what is, I don't know if concerning then, or what is something that is a major factor, and I had mentioned it in one of the very first slides, is what is happening on the international interest rate front. And if you look at the last statement by the US Federal Reserve, it has been pretty aggressive in terms of not only increasing interest rates, but more than suggesting, kind of saying that interest rates would go up by a certain amount this year. So that is quite important for us, because, as I had mentioned before, we had an interest differential that was already negative. So the pendulum is swinging, and I like how this one is. So the way the pendulum is swinging now is more in the direction of the external factors, because of how these things are being aware of, because we are part of the world, and we have to be aware of what is happening externally. So that is it on the monetary policy side. I'll just wrap up by saying our financial system remains very stable. Patrick had gone in detail on capital adequacy of the banks, how strong the capital is of the commercial banks, profitability, has they been able to weather the storm via either economizing on expenses or trying to drum up revenue. And non-performing loans, again, by any metrics, it's quite low, around 3%, down from a little higher before. But it's something that you have to be always monitoring, because we do have a situation outside that whether credit quality would always be sustained, because to the extent that borrowers find that their incomes may be compromised either because of the job situation, or because of their wages, their wage profile in the future, or their other commitments and so, then they could have difficulty in servicing their loans. So we are working very closely with the banks to keep a handle on that and to deal with credit quality. So this is how the financial system works with the macroeconomy. The last slide here is on what is your central bank doing in all this thing, because that is what you want to know. You have had a central bank. What are we doing? We are quite aware, as the presenters had talked about, of a lot of things happening, and we are gearing up ourselves to deal with this by sharpening up our own technical capacity, our own approach to things, to make sure that we focus on the essentials and not necessarily just ticking boxes, and our standards, and making sure that our standards are very, very high, as well as in communicating what we want and getting feedback from market participants, because this is all important. So I would urge you to look at our strategic plan, which is on our website. We are about 33% finished with our strategic plan now, because it's a 5-year plan and we are a year and a few months into it. So please look at that and give us feedback as you want. We do have to take into account new things that we may not have even thought about at the time, or things that hadn't been there. So we always have to be dynamic. On the legislative front, there's a major advance, and I have to thank our legislators for working to pass the insurance bill after so many years. I think it was a really an important move, and they need to be commended for the work they've been doing to get this legislation passed. Now we have our work to do to focus our energies on risk-based supervision as opposed to compliance-based, and to look at the right things. We have to do some work over the next few months in getting the legislation proclaimed via drafting up and suggesting the right types of regulations and what they call guidelines and all this stuff. So we will be working very diligently on that. As I said, improving our risk-based supervision and governance, coordinating with supervisors, particularly in the rest of the region and the rest of the country, for example, the SEC, DIC, and so forth, to make sure that we have things organized. Strengthen our technical and analytical capacities, so we spend a lot of time and energy on training and making sure that the training is correct and effective and shared, and looking at recent developments in the payment system to make sure that, because if you have a problem in the payment system, this could affect a lot of things. We have the issue of cryptocurrencies that we are working steadily to understand and to make policy judgments eventually. And cybersecurity is something that a lot of people could relate to. You know, you've heard things about ATM scams and, you know, people losing their identities online and so forth. So this is what we're doing. We are not doing it on our own. We work a lot with the regional central banks, the rest of the CARICOM region, at the Committee of Governors, at the Committee of Banking Supervisors. Then we have a new research team of all the research directors working on things. So that is very active. We also have several activities planned in collaboration with our international partners, including, let me just mention a few of the things that we've had. Just last week, we had a legal conference and workshop with the IMF, and the Bank of England joined us via Skype, I think it was. That was very useful. It was a regional conference. And then the second part, we had a workshop talking about the central bank legislation and so forth. Very, very useful. In July, we're having, as Michelle mentioned, a conference on digital currencies with the rest of the commercial banks, with the rest of the central banks. And this will be in collaboration with SEMLA and CARTAC. What do the acronyms mean? SEMLA is the Latin American Monetary Studies Association. The acronym is Centro de Estudios Monetarios Latinoamericanos. And then CARTAC would be the regional center, which is sponsored by the IMF and is based in Barbados. So we are all excited about that and they are all excited to work with us on that in July. In the Bank of Canada, now we had an attachment here, a cybersecurity expert a couple weeks ago. So that was very interesting, and we are hoping and we are working to them to see the possibility of arranging an attachment for a couple of our staff at the Bank of Canada in September to look at communications issues. Next week, the IMF will be here for a regional economic outlook. So those of you who Nicole chose to invite could come to it. That would be useful because you would see how they present and what they would have, I think, 2 analytical papers. They'll be talking about what is happening with the region, the Latin American region, the Caribbean region, and so forth, the IMF's perspective, as well as 2 papers, one on monetary policy communication and one, I think, can't remember the other one, on fiscal something. So that will be on next week, Wednesday, at 10 a.m. in these conference facilities. It will also be streamed live. And next year will be another important engagement with the IMF and World Bank together on our financial sector assessment program, where they would be looking at our financial system in detail, the different institutions, and so forth. The last full financial sector assessment program was done in 2005. There was a part update in 2010. So we look forward to that because it would be helpful. And So I just want to say thank you for all your attention. Don't worry, the drone is not taking pictures of you, but I guess to represent our surveillance. I want to thank you for your for your attention. We look forward to your feedback because it is important. We are a public institution. We have responsibilities, but we look forward to your feedback and to your questions. So I'll just leave you with some of the recap of the key points. And thank you again.
Thank you very much, Governor Patrick and Michelle. Thank you for being a wonderful audience. You know the drill, so the microphone is there. Don't all rush, come forward and ask your questions. We have persons at the head table and many others sitting among you who can respond to your questions.
My name is Anthony Wilson. I have 4 questions. What is the impact on local financial stability of the decision by Barbados to suspend payments on foreign bonds and the principal on its domestic debt? Should I ask all 4?
Yes.
Has the central bank measured the potential supervisory and prudential impact of the proposed takeover of Guardian Holdings, the country's largest insurance company, by a Jamaican bank? Does the negative differential of the TT and US short-term treasury bills have an impact on local financial stability? And how long does the central bank intend to allow the negative differential to continue? Finally, does the governor agree that the central bank's condonation of the foreign exchange black market contributes to shadow banking and white-collar crime? Thank you.
Any questions for me? All right, the Barbados thing is interesting. We clearly have a neighbor that is in very serious difficulty, just like Venezuela. So I had mentioned the whole global context that we are facing, but close to us, we have things that we have to deal with. I'm sure that the situation in Barbados and the decision that they would have taken was not have been taken very lightly. And so we are monitoring things very closely and providing support, whether in a technical sense or administrative or whatever, so that our Caribbean neighbor would be able to weather the storm. So far, the exposure of our banking system to the Barbadian assets is very minimal. It's small, it is manageable. So I don't see a particular major problem with that in the short run. To the extent that the Barbados problem, in any event, wasn't, let's say, not known, then people would have priced in or would have adjusted their portfolios, taking into account the overall situation. So no, I don't think that the impact would be quite dramatic for our local financial institution. But we are looking at it very carefully because, as more generally, as Patrick has mentioned, the issue of sovereign debt is something that all countries need to be aware of. And it is a rather tricky situation because, and I remember I was at a conference a couple of weeks ago, and it was a huge issue, in the international community. How do you deal with sovereign debt, particularly your own sovereign? So let's forget about a foreign sovereign, because your own sovereign could be borrowing from you, and they're borrowing in local currency. Should you not risk-weighted what? So it becomes very complex, and it's something that needs to be settled. And we are looking at it very carefully, and I think that we have that situation in hand with respect to Barbados or Barbadian exposure of our institutions. The second thing about the supervisory impact, no, we have not modeled it per se in the sense of looking at specific numbers on these institutions. We are clearly aware of it. We would welcome any institution, whether domestic or foreign, that shows the capability to run an institution efficiently and in the best interests of local and other policyholders. So we would judge it by how it works. We are aware of issues of potential concentration on those normal things, but this would be part of our normal assessments. But to give you a quantitative assessment of have we measured A, B, and C and worked out or calibrated, a multi-year impact, no, we haven't done this, but we have been looking, and they would necessarily need to have our approval to move ahead. So we'll wait to see what happens on the SEC side on all that, and then we will make our decisions based, as I said, on the overall impact of our assessment on domestic depositors, policyholders, the economy, and so forth, and we'll take it from there. The third thing on the negative differential, I think was, while we didn't give, we have not announced that we would be given forward guidance per se, but I think if you look at the presentation, I think our concern is quite explicit. So we clearly, when I say we, the central bank clearly cannot say what the differential would be, because the differential, well, there could be many differentials, but let's say the differential that we normally use, 3-month T-bill rate, Trinidad and Tobago. Let me simplify that for those of you who may not be too aware of what Tony may have been asking. What he was suggesting is that our interest rates in Trinidad and Tobago are low. In the United States, they are going up. And if the rates outside go up much more than here, then it could mean that somebody who has money to invest says, well, let me put it outside. So that's the simple meaning of what he had been saying. What I was suggesting is that the central bank has certain levers that it can affect interest rates, but not directly and with a lag. For example, if we move our repo rate, which is 4.75%, it could affect local interest rates, but it a lag. But I just want to assure you that we are looking at it very carefully, and that's why I spent quite a bit of my presentation in the first slide, as well as in the later slides, talking about how we are connected to the world, how capital is sensitive to interest rate changes, where we are now, the minus differential, and what our perspective will be, taking into account our other factors on the domestic side, what's happening with inflation, growth, and so forth. In terms of the last one is something about condonation of...
Condemnation.
Condemnation or condonation? No, condonation.
Condemnation, that's what he said. Condemnation of the black market leading to shadow banking.
Oh, anyway, let me interpret. I can't remember what it was. Let me interpret it as I want, and Tony, you could tell me if on the mark. What I interpret it to mean is that is the central bank aware, concerned, or about the situation in the foreign exchange market, and would it lead to, I don't know if you meant shadow banking or parallel market activity. I think that is what you are suggesting. Let me look at it on the macro side, in the sense that, as I mentioned before, once you have we do have in our still adjustment phase an imbalance in the foreign exchange market. Demand is greater than supply. What that means is that people will find, it then gives an incentive for people to find ways of going around this. So that is natural in any situation. we don't see much evidence compared to, let's say, other countries in Latin America where you had a huge, anecdotal evidence of, or maybe even more than anecdotal evidence of black market rates that are way in excess of official rates. But we do have an incentive for rates to be outside of the system to be there. And as I said, it is a tricky situation. Timing makes a huge difference. As I said, in the short run, we do have some increase in supply, which has helped to some extent. But for those who can't access for it, you'd say, well, that doesn't help me. So this is where, over time, we need to have things brought into balance. And here is where the combination, as I was mentioning, of fiscal, monetary, and structural policies would be necessary to restore durable balance, because it is not a situation that we think should persist indefinitely, because clearly, I mean, anyone could tell you that if you look just at the charts that we have and you see the reserves going a certain way, then everything will be going in that direction. So it is not a sustainable situation. We do have a possibility, but we would not, certainly at the bank, depend on it, where you could have an inflow, as I said, the mini windfall translating into a longer windfall because of oil prices or natural gas prices going through the roof. We wouldn't want to depend on that, but we will take it if it happens. But we need to organize ourselves to have everything in line so that we would be back in a calmer situation and avoid these issues of potentially parallel markets and what you were suggesting, which is a larger issue on shadow banking, which is dealt in the report.
From the indicators you've pointed out, is the economy turning around? And with regard to the latest foreign reserves figure for US $7.9 billion, it's the lowest since May 2008. Given the declining trend, where do you see the figure by year's end? And while you said that we're still at a comfortable stage, but we should not be complacent, basically, what do you see, at what figure should we start being concerned?
I don't have any other takers, so I'll have to. Thank you for your question. In terms of as I suggested, we do see some figures that we had not seen before. We had a trajectory where energy output was going this way. So we see it now picking up. Hopefully it will be sustained. So that would be one thing that would tell you that it is going in that direction. But I say hopefully is that it will be sustained. I'm not an energy economist. I don't know the details. The prognosis that it will go up, but let's see. So if that goes up, then that would be good news. But it is not enough. You have to have the non-energy side also pulling its part. The potential is there, but everybody has to be part of the game. Let me deal with the fiscal situation. That in itself is rather tricky, because to the extent that you have revenue being more than expenditure being more than revenue, as I mentioned before, you may need to have fiscal consolidation. By itself, that could be growth reducing. So you have to be watching that. The thing that could take you out of that dilemma is efficiency and also proper and effective capital expenditure. In other words, investment. So you try to make your expenditure profile as efficient as possible. So let's say targeted subsidies, targeted transfers, and so forth, and boost your capital expenditure in a way that would stimulate construction and so forth. But it is a delicate balancing act. I'm not pretending or suggesting that it is easy. If you have to try to stimulate growth while keeping fiscal restraint. So that's on the government side. The other side is on the private side. And the private sector would also have to do its part to then invest, to lobby for increased structural reform where necessary, and to do it, let's say, promote its own activity then, whether in finance, construction, manufacturing, and so forth, productive areas to make things happen. In other words, people wouldn't be able or shouldn't then, for this to work, just sit by and say, well, all right, well, I will just, let things happen. Everybody has to do their part and has to address the issues with the required calm, diligence, and confidence to make things work. And with this, I think things would turn around in a more sustained fashion, because we have been here before. We are an oil economy. We are a commodity exporter. We are subject to the vicissitudes of international prices and so. So we go through cycles. This is just one of those cycles, and we could certainly get through it. But I think it is important not only to get through it, but to come out in a stronger way and in a better way, so that the next time it happens, we are ready for any things that are not in our control. So yes, I think there is a lot of things that can happen to make things better. But we do see some signs that things are improving, certainly on the energy side, and let's wait to see if we have the right combination on the public and private side, then it could be more sustained. On the reserve side, I think, as I said, we lost about 500 million in the first half of this year. I think at this pace, other things being equal, if you don't have anything else, then we could probably lose another 500 million by the rest of this year. So $1 billion for this year, which would take us to 7.4, something like that. My maths is eluding me, but 7 point something. Again, this would be still comfortable. I mean, why does a country have international reserves? Or such huge reserves? It is for dealing with rainy day situations, which we are in. But of course, we cannot, just like on an individual basis, you have something for a rainy day. Okay, the rainy day comes. You use it, but you have to rebuild it, because rainy days will come again. So I think while we may be able to take comfort that we have some buffer, we don't want to overdo it, and we want to then be able to rebuild those buffers. When would we be worried, the central bank? Well, we are never worried. But we are always aware of things. We look at it very clinically, and we want to assure that policies are done that would then be able to rebuild those buffers as in as short a time as possible. So this year, let's say, losing another 500 million in reserves, we are not overly concerned about that, to the extent that there is a concerted program to coordinate everything so that we are able to then do things to be able to weather the future storm.
Two non-forex questions. Yay! What does the central bank think about the NIF and what sort of impact it might have on the country? And the other non-forex question is, when will the central bank give up CLICO? Like, when will it cede control of CLICO?
Okay.
Can they help you?
They're rocking back, the body language is well, let me start, and then they could jump in. Yeah, the first was on the NIF. What do we think of it?
Yeah, what do you think it'll have? What sort of impact do you think it'll have on the economy? Will it, I mean, clearly the government needs to raise,
Well,
money from.
all right. What would this? I mean, I don't know the final shape of it, but in broad terms, it is the government having assets and then being able to share those assets, or let people, the man in the street or other people, be benefiting part of it. So that's broadly what it is. It's not. So I think it's potentially a good idea. I had mentioned before, it would help in the financing of the budget. This would be one asset. Depending on how it actually works out, is either a sale or lease or whatever, but it could help in the financing. So I think that could potentially be good. The fact that the assets that are there, the man in the street, other people could invest in those, that would be useful too. So I think, and people have choices, so they say, okay, I didn't have an opportunity before, I have an opportunity now, so let me exercise that choice. I think that would be useful.
Let me clarify. Do you think it'll have a stimulating effect, or will it just be kind of neutral?
A stimulating effect on what?
On the economy.
I don't know if you'd call it, to the extent that people find that it is a better way of using their finances, then that would be stimulative. To the extent that it affords the government some financing that it could use for capital expenditure and so forth, yes, those two aspects.
Okay, and now I have a forex question.
No, but you would.
Well, you have your
Oh,
Wait,
no, go ahead,
no, right, yeah, no, we need that one. Yeah.
No one else. Yes, I don't know, man. The second question was what? On Clico?
When will they give up Clico?
Yeah, when will the central bank be ceding its control of Clico?
As soon as possible.
Okay.
No, seriously, I mean, the Clico situation has been with us for a while. It is a difficult situation that we all had to come together as a country to deal with fiscal impact and so forth, central bank. The central bank is not in the business of running insurance companies, but we have to do this thing. We have a program. Things have been going in a good fashion. Clico has been repaying. We had a very important development recently, and I have to commend the staff of the Deposit Insurance Corporation for working on that thing to have a big dividend distribution of over 50%. And so things are in the right direction. As I said, our priority is as far as possible to exit as quickly as feasible while maintaining financial stability, while maintaining the interests of the policy holders and so forth, trying to learn the lessons from this experience and to build safeguards so that we would be stronger. So this is where I can't give a particular date, but it's certainly a priority for us to unwind our activity in this area.
Right. So the forex question is, now the exchange rate is sort of inching up, whereas the inflation rate is going down. Now, I am not an economist, so this sounds inarticulate. Please forgive me.
No, you did well last time too, so you're good.
Yeah, so the exchange rate is kind of inching up, and the inflation rate is going down, but the fundamental argument for not adjusting it to something higher has been to keep inflation down. Can you please explain the relationship between the exchange rate and the inflation rate? And now, since it seems to be clearly an inverse relationship, because it was actually higher when the exchange rate was lower, is this going to influence your decision in terms of adjusting the inflation rate? Not the inflation rate, the exchange rate.
Okay, let me just start with the first one, which I think, but you could correct me if I'm wrong, is more just a kind of a conceptual description of the rate, the relationship between exchange rate and inflation. All right. What is the exchange rate? The exchange rate is the price of one country's currency for another country's currency. What is inflation? Inflation is also related to prices, because this is the domestic price, and then the inflation rate now is how fast this moves. They are related because a country would generally import stuff, and so those prices are built in. Our technical analysis of the central bank shows that there is a clear relationship between import prices, the exchange rate, and domestic prices that are lag of about 2 or 3 months. So that is somewhat of the relationship. So that if the exchange rate changes, let's say depreciates, then other things being equal, you would think that it would affect local prices and hence therefore local inflation rates. I think the second, so that's the conceptual part. I think you were saying, I wasn't clear what
Well,
was
since
the
the
second.
exchange rate seems to be going up and inflation rate still seems to be going down and lower than it was when we had an even lower exchange rate, will this impact, since it seems to be an inverse relationship between
Okay.
the two, will this impact the decision to adjust the exchange rate?
All right, that's an interesting point you mentioned, and how I'd put it is that, particularly last year, because you haven't had much movement in the exchange rate this year, but last year, was it the year before, I can't remember, but you had about a 7% increase in or depreciation of the currency, and inflation didn't adjust. We felt when we look at it at the central bank, it was because of the amount of margin or fat in the system. In other words, that the importers had their profit margins were so healthy that even though the exchange rate changed and this would add to their costs, they couldn't pass it on because people would say, I don't need to buy it anymore. Or I could buy it online, or I would go to my competition and so. So that, interestingly enough, at that particular period, when I think your question would be most relevant, we didn't see any impact of that depreciation, that 7% currency depreciation, on inflation at all, because I think there was this huge margin, and people just said, you hold this stuff. So the merchants then say, well, all right, I'm already making enough profits, let me do that. So I think that is quite important in that scenario there. And of course, in the future, well, we don't know what will happen in the future, but we do anticipate that there are, in general, you would have some positive correlation. But the other thing you have to be aware of is the state of the economy on demand and hence on inflation, because demand would affect how many people are rushing to the door to buy something. And then the more they rush, the more prices will go up. To the extent that people are laid back, they're not too sure what is happening, then they hold back. And this is, I think, one of the major things that we have seen behind the low inflation numbers that we've been experiencing to date. And you see it in the construction sector also. You see it in producer prices, as I mentioned, the price of cement and concrete and so forth, and that it reflects the demand. So
you think with this growth trend that you mentioned in like your your introduction, you think that inflation could probably start increasing now, or are we still going to try to hold it steady?
I think at some point, but I think there's still enough slack in the system that we, certainly at the central bank, we are not looking at it as a problem for this year. Of course, you could have price jumps. I don't want to be too technical, but price jump meaning that the price level could change as opposed to inflation meaning how fast it goes. If you have a tax change that says, let's tax, I don't know, let's tax my name or something. And then yes, possible. Yeah. I like that one. But if a tax goes on something, then it could raise the price of that. So, but we don't know. But that's what happened with tax changes. But apart from that, the demand side, we don't see that certainly for the rest of this year.
Right, great. And then for your colleagues, see, I'm trying to include everybody. Ms. Panta, in terms of cryptocurrency, what sort of trends are you seeing in Trinidad in terms of adopting the currency? Now, I know the banking sector had a forum the other day where they said that it's going to evolve whether we like it or not. Are you seeing any sort of trends? Are people, is it just nerds who are into cryptocurrency, or people starting to embrace it?
Okay, well, what I know would be just purely anecdotal. You don't collect data, so it's based purely on expression of interest or in terms of what people say. So I don't have a sense of how fast it is growing. So far, we only know of one person who openly said that they accept bitcoins at their establishment. Persons have been coming to the central bank with expressions of interest, but it's at that stage. We have not registered any person as a cryptocurrency payment service provider. So I don't have any figures that I could quantify, just that you know that people are in this space and investing. I wouldn't say we are ahead of the curve. I think, as I mentioned in the presentation, there's a bit of wait and learn because it's evolving so much and so rapidly. We don't want to come with a position too early and then miss some of the key signals. So we have been collaborating with people in the space, with our fellow regulators, to determine what our best approach should be.
Thanks, Ghana.
Thanks for including me.
Give anybody a chance. They would like to come forward. I mean, so far we've just heard from the journalists. But we know we've kept you for a long time. And you have been a wonderful audience. We want to thank you for coming. We will feed you. So there are refreshments through that door because we know it's about that time of day. Thank you. God's richest blessings until we see again. Some of you who I picked, I will see next week. Please go on. All the best to you. Bye.